Okay, let's talk about Google here. I'll be honest with you. I'm interested in this one. I'm probably going to take this with you. Full disclosure here. So what do you got?
Okay, so a couple of things. Interestingly enough, for these tech names, I am noticing that the market makers are being very conservative with motion, and that's giving our positions a lot of potential upside when they do move. So, Google's had a few problems. And so the reason, let's just use this from a pure numbers perspective, and then we'll look at the picture. So the first thing is that we notice the market makers are positioning a $12 move into the earnings. And further down the line, we've got the 21st of Feb expiry, and they are only 15, maybe almost $16. So it's 20% more than what the market makers have done. But what I've been noticing is that the market makers are coming, they're not pricing their options so expensive that we can't chase the move in. So what we can do are two things. We want to look at a pre-earnings release, and then we want to look at a post-earnings trade. So for the pre-earnings trade, let's take a look at where all the traders are sitting. They're sitting at $220, 10,000 of them right there. 220 is $13 higher than the current price, which matches the market maker. Okay, so chances are a fair bunch of these guys are short. Just saying, if they're selling the spread, looking for vol, the implied volatility is not very high, which is why these options are a little bit cheaper. You could do two things. You could say, hey, I want to get inside that move, and so I'm going to take the 210, 220, 230, and that's going to be $1.76. If you're looking for the outsized move that the traders that have the option chains have been really missing the mark on, you could do the 220, 230, 240. And that is $1.10. Okay, as opposed to $1.73. So we can look at both of those from that perspective. The put side is, I'm looking at the same amount, $13, $18, something like that. We know that if there's a put pressure event, it's probably going to be more aggressive than a call pressure event. So again, I went to see where all the traders were sitting at that 185 level, and I took the 185 to 175 to 165 position. Now, you'll notice that 155 has got open interest of 23,000.
Yep.
Again, my thought is that these are folks that have sold the options. They've put an obligation. They've put an obligation in that says, hey, listen, if it comes into 155, it's a good buy. I'm going to take it. So they're committing themselves to saying, all right, if it comes into 155, I'll buy it. So let's see from a picture perspective why they might have positioned there. So here we are. Look at how far away 155 is. It's right here around the breakout area. Old resistance, support, a brand new high, a retest of that breakout, and a move forward. So the traders are thinking, you know what? I'll buy this. It's a good buy here at 155. And so I can see why they've positioned themselves as an obligation there. So let's take a look at, because my brain is a sieve, I can't remember, 220 is where most of the traders are positioning on the short side. There's nothing else that's bigger than this open interest area. That's 220. So let's take a look at resistance. If we stare down the chart for what's been going on in the week, I'm going to double our handy dandy box.
Okay.
And I'm going to put it up here. And we're going to see that the halfway marker of that box is about 219. Here's the halfway box here. I'll move it here. Whoopsie. Come along, Fred. Activate drawing. There we go. Halfway on the box. Looks like about 219. That's what my eyeballs are telling me. So again, it seems clear to me that those traders have also sold that, and they're willing to take themselves probably to 225 before it rotates up.